Preference shares or preference equity. The formula over here is very simple actually. Again, it will be denoted as KP. I am just using it for my own understanding, which will be equal to dividend upon P0. P0 is always share price, and this share price should always be X dividend. Okay.
KP is our the
Cost of
what
preference.
is KP at? Cost of
KP.
preference. Okay.
Yeah. That's a formula, nothing big.
Yeah, and I'll just write it down if I want to remember.
Okay, so now let's talk about preference equity. The formula is KP equal to D upon P0, where D stands for dividend this year and P stands for share price. Now, the best part of the preference share is it is directly given. For example, 12% preference shares, 13% preference shares. What is 12%? 12% of nominal value. Nominal value of share is always 1. Just put it down somewhere, everyone. Nominal value will always remain 1. Okay, I'll just write it down somewhere. Okay, I'll write down over here only because we have to calculate it over here. So D is always given as percentage. Nominal value is always 1. Nominal value of share to 1 unless or until it is given something else. So just remember that part. Okay, so basically there's a question which is given. A company with 12% preference shares, 12% preference shares, where nominal value is given as 1 and X dividend market value, X dividend market value is given as 1.15. You have to calculate and find the answer of cost of preference shares. So very simple. 12% of $1 is equal to how much? 0.12 divided by share price, which is 1.15. That's it. So it will be equal to 10.4%. So the formula for cost of preference share is pretty simple. We don't have to worry much onto this side. Okay. So now let's move to the next part, which will be your debt. Let's move to the debt part, everyone. Over here, when I talk about debt, again, there will be concept of nominal values and market values, and then there will be coupon rates. Debt, generally, you will notice they have talked about bond. So bond is what? An instrument that represents a loan by an investor to a borrower. It's a simple kind of loan that can be provided everyone. Okay. Now we have two types of value, nominal value and market value. Generally, nominal value of loan is equal to 100 unless or until it is mentioned something else. Again, over here, bond value can be X interest and cum interest. You will always have to consider X interest values. Generally, in these areas, they won't confuse you with X interest or cum interest. In share prices, they can confuse you. Okay, this is about debt part. Up debt may you have to remember you have three things. If you remember, irredeemable, redeemable, and convertible. Now we have to understand the formula for each of these. First of all, we have irredeemable. Sorry. Irredeemable debt. Irredeemable debt. Formula over here. Again, irredeemable. What does it mean, everyone? That there is no requirement to pay initial cash flow or the principal amount in future. So there is no requirement to do that. Then we have redeemable debt. Oh, sorry. Then we have redeemable. Redeemable debt. And then we have convertible. So convertible is very simple. We don't have to worry anything about the convertible wala part. First of all, these two are the important one only. Okay.
Okay. Okay.
Now let's talk about formula. Irredeemable debt. Very simple. We don't have to worry anything over here. Over here I write down cost of debt, which is equal to how much, everyone? Interest upon, generally over here you will use P0, which is again what? Value of debt. Okay, that is X interest market price. P0 is denoted as X interest market price. Okay. P0 denotes price after interest. Price after interest. Okay. Now, if the debt is tax and is going to provide you tax benefit, so you do 1 minus T. So this becomes KD 1 minus T. That is your actual cost of debt, everyone. Actual cost of debt. Okay. Up over here, the question won't be very tough or anything like that. It will be pretty simple only. I'll write down the question as well. So question says 12% bonds. Nominal value is given as 100. Market value, cum interest. Cum interest is given as 92. And tax rate is given as 33. That's it. Okay. So first of all,
Could you explain like what is like a cum interest and the other
it
thing means
includes
like
the interest. It includes the interest.
so,
And we always have to consider post interest, post dividend things. Okay. So now, first of all, let's find out I. Interest is, sir, 12%. So 12%, 1 minus tax, 1 minus 0.33 upon share price, sir, which is, sir, 92 market minus what is interest? 12. 92 minus 12. What is the final value? Over here it will be 80. On the above it will be 12 minus 1.33 is 0.67. So 12 multiplied by 0.67 will give you 8.04. So the final value will be close to 10-11%. I'm not sure. 0.04 divided by 10.05. Okay. 10.05.
yes, sir.
Now, before I move
So
forward, I have one point. Okay. Ajay, you
okay.
can talk about.
Yeah, no, I just yeah, like it's simple. That's it. Okay. Yeah,
Okay.
you continue.
Okay. Now, cost of equity, guys, listen. Cost of equity is always equal to return on equity. But cost of debt, remember this line, purple, cost of debt is not equal to return on debt. Whereas cost of equity is equal to return on equity. Absolutely. There is something that is called as tax ka difference. Correct? There is something that is tax ka dividend,
Yes, sir.
difference. That is why cost of debt and return on debt is not always equal. So if the question is asking, find out the return on equity, return on debt holders. So you will not consider 1 minus T. You will not consider 1 minus T. You will only take KD. Over there you take only I. But now guys, if the question is directly asking, listen very carefully. If the question is directly asking, that you have to calculate return on debt holders. So always remember, cost of debt and return of debt is not equal, even though cost of equity and return on equity is equal. Point over here is that why it is not equal, because in debt we get something that is called as tax benefit. In equity we do not get that. That is why, because I get tax benefit, my cost of debt is not equal to return on debt. One point is that, everyone. Second point, if the question is asking to calculate RD, you will only solve for KD. You will not solve for 1 minus T. You will not even consider I 1 minus T over there. So that will make things a little easier for you. Up over here for redeemable debt. Now, what is redeemable debt, everyone? A kind of debt where we are not supposed to pay any. We are supposed to pay. Sorry, not supposed to, I'm saying. Where we are supposed to pay two things: interest as well as the initial cash flow or the principal
Like
amount.
the
We have to
principal
pay
amount.
both.
Okay.
How do we solve it?
Mm.
Simple. Using IRR formula. As simple as that. Just use IRR formula and that's it. So we'll do this thing over Excel once. Okay, I'll solve one question on Excel. Then we have one more form of debt, which is in convertible form of debt. You have to solve for one more step, everyone. At the last year, guys, in convertible debt, at the last year, remember one thing. At last year, find if debt is taken, if equity is taken. Now, what do I mean? But what is convertible? A kind of debt that can be converted into equity at the year end or at the maturity time, not year end, at the maturity time. So now you have to find out, sir, what will be the value? How can you do that? How can you find out the value? Beta, for that you have to find out whether I should take debt at the end or should I take equity at the end. Two things, whether I should take debt at the end or whether I should take equity at the end. If you go with debt, find the value of your cost of debt based on that value. Now, how to do so many things? This is something that again I'll solve in the Excel. Again, you will be using IRR formula. Use IRR. As simple as that. The company has issued 200,000 7% bonds, redeemable at a premium of 5% on 31st December 20x6. Interest is paid annually. It is January 1st 20x3. Yani it is for how many years, everyone? Sorry, it is for almost I would say. Today's first Jan 20x3, x4, x5, x6, 4 years. Okay, so discounting is the simple thing that we have to do. First of all, the very first cash flow will be, you would say,
Cash outflow, right?
first cash. Yeah, first payment, or I would say, when 0, 1, 2. What will that they will pay? They will, investors. Investors are going to pay me how much, everyone? Bands are trading at 98 minus 98. Now, how much will those investors get?
Okay, so we are creating this in the point of view of our investor, not as our company, right?
This is for us only, but what happens? Either I keep minus over here and positives over here, or I keep positive over
Yeah,
here
or else
and over
switch.
here. So I just switched it
Yeah.
so that easy for me. Now, what is the return that they are going to get? Sir, 7%. There is no tax point. So 7 over here and 7 for the 4 years, right? So what is the net cash flow? Well, 98 equals 7, right? So what will be equal to
The
IRR?
7% of 200,000 or just like
7% of nominal
what
value.
is it? Nominal, okay, 100, okay, all right.
7% you will always consider for nominal value, nothing else. Okay, we have to take one more cash flow. There is one more cash flow which is at the end 5% premium. So redemption will be at 105. So this will become how much? 90 at negative, 105 positive will become this plus this. Okay, so what happened over here? It is not giving me any value. Wow. Oh, sorry, redemption will be at year 4, right? That is why. This plus this. This is what I'll get. Well, IRR bracket open. Take all the values. So 9% will be your cost of debt for the preferential debt. Sorry, for the redeemable debt. Now, in the very same question, if we have convertible. Okay, in the very same question, what if we have the convertible wala concept? Now let's assume that the convertible is current share price is given as 4.45. Okay. Current share price is given as let's assume the share price, current share price is given as 70.
Well, like the market value, right?
Value at end of 4 years, assuming उसको 70 क्या करते हैं 15, and assuming after 4 years you will get 6 shares, value increase by 10%. ठीक है? So now against every one bond you are going to get how many shares? 6. Correct? Now one bond is of 105 rupees at the end of year 4. We need to find out what will be the value of my shares, total value of shares. Total value of shares will be equal to, sir, I have 6 shares multiplied by, uski current value is 15 into 10%, it is 1.1. 1 plus R, 99. So now tell me, if you are an investor, will you take debt which is of 105 rupees, or will you take equity which is of 99 rupees? Most of the people will always say debt, everyone. So this is how you can solve the normal question of convertible equity. Now there is one more thing that we have to talk about before we actually move forward. That is your semi-annual interest payment. Okay. In these kind of things, you have to find out the effective annual cost. You have to find out effective annual cost.
So,
Now, effective annual cost, what is the formula for effective annual cost? So we can do that by putting the formula 1 plus semi-annual cost raised to the power 2 minus 1. This is the value if we have to find out any interest which is semi-annually provided. Okay. So we have this question, 6% bond. Again, solve for NPV, everyone. Current value is given as 96. For this question, I'll directly solve it. I'll just put down cash flow, then I'll write down minus 96, 0, 0. It is 31st December 20x9. It is 20x1, x7, x8, x9. 3 years. Then year 1 to year 3 will have the interest. Now at the end of year 3 we'll have interest plus nominal value 96. Then what will be equal of IRR? Equal IRR value open. Take up all the values. So what is my IRR? It is should not be 3%. It should be somewhere 3.125. Now it is fine. Okay. That will be equal to 1 plus semi-annual cost, which is 3.25. S to the power 2 minus 1. 0.64. Point 64.